Hello, Stamford Field Office, owner operator, community, and your families. Obviously a tough time, but with tough times, all the tough people stand up, and I'm proud to stand with all of you. Spent a lot of time over the past week digesting all the information on what I'm going to refer to as the CARES Act, and this is as of the information effective on March 27th. And the reason I emphasize that is, as we speak, I've had dialogue through many individuals, and we're finding that there's probably going to be some technical corrections to this act. But as it stands today is what I'm going to talk about. There'll be a quiz at the end where we can see who knows what CARES Act stands for. We can go to the next slide. Beautiful picture of me for those of you that don't remember and know what I look like. And on to the next slide. So the first component of the CARES Act, or the first section of the CARES Act, is referred to as Keeping America's Workers Paid and Employed Act. This is what I view as the most critical component for you and your teams. Next slide. What Paul Handel referred to before, people are calling it the PPP program, or the tongue twister of Paycheck Protection Program. There's been a lot of questions about who's eligible. I think most people probably on this call at this juncture realize that you are eligible. I've outlined the majority of the eligibility thresholds, but for those that were concerned that they might not be an eligible organization, do not confuse this with the paid sick leave components. The 500 employee threshold is on a per unit basis. That was an exemption specifically for restaurants or organizations that begin with an NAICS code of 72. It also includes self-employed organizations, so whether you're an S-Corp, whether you file as an independent contractor, most organizations are going to qualify. The big component is that your organization in the restaurant must be in operation as of February 15th, 2020, and the coverage period for this program is February 15th, 2020 through June 30th, 2020. A few other key points, because I've gotten this feedback from others that have spoken to their bankers. They've been told that they're not going to be able to participate in the SBA program unless they get turned down for credit. That has absolutely been stricken. There's specific language that excludes the credit elsewhere test. So you do not have to apply to your current institution and be turned down to apply for this program. It's also important to note that there's no collateral or personal guarantees, and that was critically important from your banking perspective, so that you will be able to get this without being in any kind of default with your current lending institutions. Next slide. So the big thing is how is this, calculated? And it gets a little confusing, but if you follow with me, obviously I can't see your faces, but I'm going to try to make sure I explain this as clearly as possible. The most important component is Paycheck Protection Program is designed for you to keep people employed and keep them on your payroll. So the whole program pretty much revolves around the number of employees you have, both full-time and full-time equivalent employees, and the salary or wages that you pay them. That's the baseline. That's where we're going to start with every single measurement that we are going to go forward with. From there, we will take that calculation, and it takes 2.5 times your total monthly payroll costs incurred in the 1-year period before the loan is made. The one thing that we will note, and it will not impact many, but it will impact some, is there's currently a ceiling of $10 million per organization. That is currently being discussed as far as I'm aware, and there's a good likelihood that that will be reversed for you large organizations that might be impacted with that. Next slide. So what do you include in payroll? So payroll, as you see on the left, includes everything that you pay to your employees, their wages, their bonuses, if they have a commission plan, anything that's documented in payroll would be included. Obviously, your organization do not have tips, but vacation pay. If you have paid medical sick leave, if you're an organization that was greater than 500 and you paid your employees, if you paid vacation pay, dismissal or separation pay. It also includes if you have anyone where you have a retirement benefit. So do not forget that. If you have someone where you're issuing from your organization a 1099-R, those are includable. If you have independent contractors that are working for you that theoretically are on your payroll, it is possible that you will be able to claim them. In addition, you will be able to add in the medical benefits that you pay on behalf of your employees, so do not forget that, as well as the state and federal unemployment insurances that you will also pay. Those are add-ons. What is not included? So many people are confusing the fact that we're talking about a $100,000 employee threshold or even business owner threshold. That doesn't mean those people are excluded. All that means is that anyone that makes greater than $100,000, anything above the $100,000 does not get included. So someone that makes $125,000, the 25 is not a component, but $100,000 does go into the calculation. Social Security and Medicare taxes that you are paying as the employer does not get added in. And a critical component is if any of your employees, for you organizations that were 500 or less employees, if you're paying any sick wages or family leave, those wages that you pay do not get calculated because you are getting reimbursed for them through the federal program. Next slide. So here let's let the rubber meet the road. Let's just do some examples because I think examples, are just a little bit more clear to understand. Little drink. I'm drinking scotch. You guys can't tell. That's the good thing right now. All right, total payroll cost. So we look back, and this is what you do in your organization. If you have one company or you have multiple companies, you'll do it individually for your federal identification numbers, and you're going to look back 1 year before the loan is made. In this example, we have $830,000 of labor costs. Those are the costs as disclosed in the prior slide. The average is taking 1/12 of that. We multiply that times 2.5, and that gives us the maximum amount of the loan. So in this example, we can borrow $173,000 through the PPP program. And you will be able to borrow the $173,000. Next slide. So what is the money used for? Well, by very definition, the Paycheck Protection Program was designed to give you money mostly for payroll costs. So if you look at the program, we're getting money that we can use for payroll costs, we can use for rent, we can use for utilities, and there's been some confusion out there because the regulations in reference to interest, the first component discusses mortgages. McDonald's owner-operators don't have mortgages on their stores. But for those that have read the details of the legislation, if you read further down, it refers to interest on obligations incurred prior to February 15, 2020. So the McDonald's debt that you have with your bankers will be a cost that you can use the Paycheck Protection Program funds for. Next slide. So now you have this money. Short of just going to Las Vegas, in order for us to be able to get that forgiven, and the critical note is you do want these funds forgiven, the loan the forgiveness, let me backtrack, the amount that you get when we do the calculation cannot be forgiven in an amount greater than the amount you borrow. That would seem rather obvious. But then there's a formula to calculate how the forgiveness is determined. And that formula revolves around employment. So it revolves around taking the average number of full-time employees and full-time equivalents, and it looks at any reduction of salary and wages that you have with your employees. Next slide. So this is how we start to determine the average number of employees, and you have two options here. So if you look on the left side, it says average full-time equivalent employees per month during the 8-week covered period. There's a little confusion here. We're waiting to get clarification, but the 8-week covered period, there was a publication by the Senate that basically had stated as a handout that you can use any 8-week period you would like from February 15th through June 30th. What came from the U.S. Chamber of Commerce was that it was the 8-week period following when you had gotten the funds. As I read the legislation myself, that's the way I read it. So you should speak with your CPA, your advisors, just to make sure that you clearly understand what the correct 8-week period is. The denominator for this equation is the average full-time employees and full-time equivalent per month from February 15, 2019 to June 30th, 2019, or it takes the same metric as the numerator, but on the denominator, it uses the average of full-time and full-time equivalent employees per month from January 1st, 2020 to February 29th, 2020. You have a choice of using either one, and I'll explain the importance of that option in a few moments. Next slide. One thing that you're going to want to keep in mind, and this is critically important, many of you are going to have less employees on your payroll now than you had in any of those measurement periods. Whether a restaurant is closed or simply you're going to, drive through, walk up, we know we don't have all the dining rooms running. When you see the calculation, you're going to understand the importance of having the employees, back in terms of being able to get added back to your payroll. In addition, we have to focus on not reducing wages greater than 25%. There's a measurement that looks at the 25% of employee wages. Next slide. So now we're going to put the numbers to work. So if you remember on that prior slide where we talked about taking the average full-time and full-time equivalent employees per month during the 8-week period. So now you do the measurement, and in the first instance, or in that instance, you have 80 employees. You look at February 15, 2019 through June 30th, 2019, and your average is 100. Well, what that tells us is that based upon employee count, you have maintained 80% of your employees. So what that means is based upon that original calculation, the maximum amount that you're going to be able to keep and have forgiven is 80%. So one can see it's critically important, if you want it all to be forgiven, that you get as close to, or if not at, 100%. If you see the formula below, now I'm giving you an example of the number of employees January 1st, 2020 through February 29th, 2020. In this instance, it's 90. So when we look at the percentage, that's at 89%. Well, we certainly would prefer to be at 89% as our metric. That's also important to note for organizations that were not in business during the February 15, 2019 timeframe and June 30th, 2019 timeframe. This is the measurement period that you would be able to use. Next slide. So here's an example of how we deal with calculating for the wages. So we have employment wages covering the 8-week period of $127,692. In my example, I'm making an assumption that we have one employee that is earning over $100,000 a year. In this instance, this employee is earning $125,000. So what we need to do is we need to allocate that $25,000 over 52 weeks, and 8 weeks of that amount would be $3,846. Thus, the maximum amount of salaries that we are going to be able to use in the equation is going to be $123,846. Next slide. I kind of hit on this. I jumped the gun a little early, but this was what I talked about in terms of rehiring. If you do not meet the metric of having enough employees, so where we showed in that prior slide where we had either 80 over 100 or 80 over 90, the law allows you, anyone that was terminated post February 15th, 2020, and ending 30 days after the enactment of this act, you will have the ability to add those people back to your payroll by June 30th, 2020, and that does not affect the relationship in terms of the numbers calculation as I presented before. That's critical to understand and talk that through with your advisor, and it also gives you a planning point so that you can bring people back on board if you were not meeting the metric as you currently stand today. Next slide. So now let's go through the forgiveness calculation. So if you recall in the earlier slides, I showed you had $172,917. That was the amount of the loan that you were able to get. If you recall, based upon the initial metric measurement that I gave you, the maximum amount that you were able to keep was 88% or 89%. So that means the maximum amount available for forgiveness is $153,704. The next step is you got to spend that money. You cannot keep it. So what becomes the qualifying expenses? Well, then you saw in the last slide where I showed you how we calculate qualified labor. Qualified labor that we spent was $123,846. If we had no other expenses, then we would have to give back the difference between 153 and 123. But in this instance, we have utility costs. We have interest, and I put paid because the legislation says the words paid. So it's critical, at least as we're reading it today, that you understand that you must pay. Most of you, if not all of you, are operating as accrual-based taxpayers. If you don't write the check, if you don't have proof of utilization of those funds, as we're reading and understanding, then you will not get credit for that, for the utilization of the funds. The idea behind the legislation was to put money in your hands quickly so you can put money back into the economy, not to hold on to the funds. So we look at interest paid. We look at rents paid. Rents paid, by the way, are not just McDonald's rents paid. Any leases that you have, so your POS leases, if you have equipment leases, all of that counts as rents paid. So if you add up all of those expenses, we come in this instance to $150,564. The maximum amount of loan forgiveness is the $150,564, even though we qualified for $172, and then it was adjusted because of our labor percentage to $153. Since we did not spend $153, we only get to keep $150. So keep in mind that if you're monitoring this, if you would have given an employee a bonus, you basically would have gotten to keep that $3,000. Government gives you $1, you give it to your employee, you look like a rock star. So obviously you'd rather give the money to your employee dollar for dollar than have to send it back to the government. So again, planning point, you're going to want to stay on top of that. One of the key things, and you see my little circle there, this money amazingly is tax-free. So for those of you that are doing the math, you're going to be able to get a tax deduction for the $150. So you're going to get a tax benefit with the write-off, and you're going to get to keep $150,000 tax-free. It's no different than as if you put the money into the business yourself. This is a huge, huge help for you in this very, very dire of time. Next slide. The unforgiven amount, so if you took the example above, I showed you that, okay, you had to give back $3,000, or excuse me, the difference between 172 and 150. What do? Well, one, you can give the money back. This is a guaranteed loan from the SBA, so you give the money back, or you can borrow that money up to 10 years and right now they're telling us that the interest rate will not exceed 4%. If you decide to pay it back, there's no prepayment penalties. So that, as quickly as I could, covers the majority of the components on the PPP alone. There are other things I wanted to highlight for you that are also critically important. So we can go to the next slide. Go to the next slide. Many of you were waiting for a couple of years for what they called the Qualified Improvement Property, or many people called the QIP legislation change. This was huge for your ability to be able to write off much of the major improvements that you have done previously or will be doing. The important component here was much of your improvements fell into 39-year property if you didn't do cost segregation studies. And as a result, you ended up with 39-year property where through some planning, some of you might have been able to get Section 179, but there was no bonus depreciation. And Section 179, by its nature, has built-in limitations that I'm not going to go through today. But if you did have 39-year property that you were not able to take advantage of Section 179, you should speak with your tax advisor, your CPA, and look to amend your 2017 and 2018 tax filings, because the QIP correction now gives you the ability to have 100% bonus depreciation. That is a very, very big item for you in the past and is a very big item going forward. Next slide. Another big component here, and this will give a lot of people a lot of planning opportunities, retirement benefits. Right now, some of you might, need capital. You have the ability to take $100,000 out of your IRA without any early withdrawal penalties, or if your business has a qualified plan, you can take the money out of the qualified plan also without any early withdrawal penalties. The great news is if you need to keep those funds, that those funds, the taxes can be spread out over 3 years, so you minimize the impact. The other benefit is that you will have 3 years to put those funds back into your retirement accounts. So again, critical planning that you would want to have as a conversation with your advisor. The one thing which I will caution you all about is unless you were astute enough to pull the money out before everything pulled back, any money you pull out today is probably at a low point. So if you went to pull out $100,000, the likelihood is if it was a diversified portfolio of mutual fund stocks in there, it probably was worth 8 weeks ago closer to $150,000. So you just probably want to just be cognizant that that could be harmful to you. Another planning note is for you, those of you that were looking at IRA contributions, that time frame has been kicked to July 15th, 2020. And also those of you that have not taken mandatory distributions, that has also been waived, so you can keep money in your accounts if you didn't need it. Next slide. Another component is delay of payment of employer taxes. Now, it's critically important that you speak with your tax advisor because some of the provisions cannot be used simultaneously. So you're going to need to do some planning, but you should be aware that there is a provision for you as an employer to be able to defer paying the employer taxes that otherwise would have been due this year forward to 2021 and 2022. Next slide. There's another provision that is out there. It's called the Employee Retention Credit. And again, a lot of these cannot be used in conjunction with PPP, but with effective planning, you can do some timing that might be able to help and provide you with some benefits. So make sure that you look at the eligible Employee Retention Credit Program. My hope is that most of you will not qualify. The reason I say that is in order to qualify for the credit, your business revenues must be down by 50%. Obviously, we don't wish that on anybody. Unfortunately, we are well aware in, our New York market, particularly in the 5 boroughs, that we are seeing restaurants, that are down greater than 50%. We're also seeing that, up in Boston, some of the metropolitan, the city environments. So it's something to be cognizant of, but it's going to be applicable to very, very few. But people should know that that credit is there. Next slide. So questions in the future. Otherwise, next slide. That's my contact information. If you want to write that down, whether you're a client of mine or not, please feel comfortable. Reach out to me either via email. I always accept phone calls. You can text me. You can follow us on our webpage. We're posting updates all the time, trying to keep people informed. So again, Stamford Field Office, keep your chin up. We're a tough group. We're going to get through this. We're going to be better than we ever were. I believe in you. Thank you for your time.
All right. Thank you very much, Andrew. And just a reminder, you can use the WebEx chat feature to send in